Okay, picture this. In just 24 hours, the entire global financial system gets absolutely rocked to its core. We're talking about a sudden, violent cascade of selling that just wiped out trillions of dollars in wealth. This wasn't just, a bad day for the market. This felt like the whole system was breaking down. So let's get into it and unpack what really happened.
So get this. In a single day, $1.6 trillion. That's the amount of value that just, poof, vanished from global stock markets. It didn't matter if you were looking at New York, London, or Tokyo. It was a sea of red. Just a coordinated panic that pretty much spared no one.
But the pain wasn't just in stocks. Oh no. At the exact same time, the crypto market was going through its own absolute catastrophe. We saw over $9.4 billion in leveraged positions get forcibly liquidated. That means millions of accounts were just wiped out, some in a matter of minutes. This was a true, all-out assault on every kind of asset.
Which, of course, brings us to the big question, right? How did everything go so completely sideways, so incredibly fast? Was this some kind of hidden flaw in the system just waiting to blow up? Or was there some invisible chain reaction that pushed everything right off the cliff? Well, to find out, we have to dig a little deeper.
So let's break down the actual damage. See, in a crash like this, money doesn't just disappear. It runs, it flees. And the real key is figuring out where it went and what it was running from. That right there tells you everything you need to know about what the market was thinking in that moment of panic.
What you're looking at here is a classic risk-off event. It's when investors just dump anything that feels risky and sprint towards safety. You can see the Dow just plummeted, down over 1,500 points. The VIX, which is basically the market's fear gauge, spiked way past 20. That's a huge sign of anxiety. And where did the money go? Well, it rushed into the classic safe haven, gold, which actually went up over 1%. And that 4% drop in crude oil? Oof, that is a terrifying signal that the market was bracing for a massive global recession.
And this really gets to the heart of it. In moments like these, all the fancy charts, all the earnings reports, they become totally meaningless. The market isn't being driven by fundamentals or technicals anymore. It's driven by one single powerful emotion, pure, raw panic.
So, what lit the match? The trigger wasn't some financial hiccup. It was a geopolitical earthquake. To really get to the root of this, we've got to rewind the clock about 48 hours before the crash even started.
And here it is. This is the chain of events that lit the fuse. On October 9th, China played its ace, restricting exports of rare earth elements that are absolutely critical for U.S. defense tech. We're talking F-35 fighter jets, nuclear subs, the works. Just hours later, President Trump responds with what was basically an economic bomb, announcing a 100% tariff on all Chinese goods. The message couldn't be clearer. Globalization as we knew it was over. And the market's reaction? It was immediate, and it was brutal.
This quote just perfectly captures the thinking behind China's move. This wasn't just some trade squabble. Nope. This was a precision strike aimed right at the heart of America's defense industry. It was a high-stakes, geopolitical chess match between the world's two biggest economies.
But here's where things get really interesting. Because while we know the trigger, the way the market fell can be explained by two totally different and frankly equally believable theories. So the question is, was this just an accident or was it a crime?
Okay, before we dive into those two theories, you need to understand this one concept. Value at risk, or VAR. The easiest way to think about it is like an automatic braking system for the biggest firms on Wall Street. When volatility, that market fear, spikes past a certain point, these algorithms don't ask for a human's permission. They just sell, mechanically, instantly, all to cut down on risk.
Okay, so this leads us to two very different possibilities. Script A says the crash was basically an unavoidable accident. An algorithmic death spiral, where one firm's automatic selling triggers another firm's, which triggers another, and so on, like a terrible domino effect. But Script B suggests something way more sinister, that someone with inside knowledge of those political announcements used the chaos like their own personal ATM.
And this, right here, is the evidence for Script B. Just 30 minutes, 30, before Trump's tweet that shook the world, a brand new, totally anonymous account placed a gigantic bet against the market. And in just a few hours, it walked away with a cool $200 million profit, and then just vanished without a trace. I mean, come on. Coincidence, or is that the signature of a perfect crime?
But here's the thing. While we're all sitting here debating which script is the right one, the professional traders, they're already playing a completely different game. They don't get stuck trying to guess the why. They focus on a totally different question.
This is the huge mindset shift. See, amateurs are always trying to predict the future. Professionals, on the other hand, they calculate probabilities. They aren't looking for certainty. They are hunting for opportunities where the potential reward is just so much bigger than the risk.
So their very first move is to classify the crisis. They ask themselves, is this a structural change, like the 2008 financial crisis, where the actual rules of the game are broken? Or is it a shock event, like 9/11? Horrific, violent, absolutely, but ultimately temporary. How they answer that one question dictates their entire strategy from that point forward.
And this all builds into a system, one they can use over and over. So once they've classified the event, which in this case is probably a shock, they start calculating the odds. Then they execute strategies that don't even require them to guess which way the market is going to go. A perfect example is something called a pairs trade. You buy a safe haven like gold, while at the same time you short or bet against an industrial metal like copper. This way, you're not betting on the market's direction, you're betting on the relative performance of safety versus risk during a crisis. It's a whole different ballgame.
Okay, so this brings us to the really critical question for pretty much everyone right now. How do we know if the storm is over? What are the key signals to watch that can tell us if we're actually seeing a recovery, or if this is just the quiet before the next big drop?
For the next 72 hours, honestly, you can just forget the news headlines. These are the 4 dashboards that really matter. First, what are the futures markets doing before the opening bell? Second, is that VIX Fear Index still stubbornly stuck above 25? Are we seeing another wave of forced liquidations in the crypto world? And finally, is the bond market, the so-called smart money, showing any signs of stress?
And let me be crystal clear about this. If these indicators are flashing red, it is not a buy signal. It is a giant warning sign that the financial system is still hemorrhaging cash, and the risk of another wave of that algorithmic selling is still incredibly high.
You know, when you really boil it down, this entire event just exposes the central conflict of modern finance. We've built this system on the cold, hard logic of algorithms like VAR, but it's constantly getting thrown around by the most basic human emotions: fear, greed, and of course, political ambition.
And that leaves us with one final thought. Look, we can't predict the next president's tweet to the next algorithmic flash crash. So the real question isn't what's going to happen next, it's what's my system for when it does? In a world this chaotic, how do you build a framework to not just survive the mess, but maybe even find the hidden opportunity inside of it?